You budget, you work hard, and you watch your spending. But lately, no matter how carefully you manage your bank account, it feels like invisible economic forces are siphoning away your progress. Rent is climbing, and filling your gas tank is becoming a major financial decision. This chart proves the pain isn't just in your head. By May 2026, headline inflation surged to 4.2%, driven by a staggering 23.5% jump in energy prices over a single year. While prices are spiking, overall economic growth is stalling, dropping to a sluggish 2.1% in the first quarter of the year. Economists have a specific, terrifying term for this rare combination of rising costs and a slowing economy: stagflation. Misunderstanding how these forces interact will lead to years of financial erosion. However, recognizing the mechanics of the squeeze allows you to reposition your assets and protect your standard of living before the damage becomes permanent. The immediate trigger for this global crisis was the 2026 Iran war. The closure of the Strait of Hormuz instantly choked off 20% of the global oil supply, creating a massive bottleneck in the energy market. That disruption traveled through the global supply chain, directly inflating the price of American gasoline and consumer goods. Shipping costs surged, and businesses passed those increases directly to you. This looks like a repeat of the 1970s. The common myth is that the 1973 oil embargo caused that decade's economic devastation. But if we look closer at the data, that narrative falls apart. Dallas Fed research reveals that inflation was already climbing long before the oil shock hit. The true underlying cause was massive government money printing after the US closed the gold window and funded the Vietnam War through debt. An energy shock can cause a temporary spike, but it cannot sustain a decade of inflation on its own. That requires a central bank to make a specific, catastrophic policy error. In the 1970s, Federal Reserve Chair Arthur Burns made that exact error. He chose to accommodate rising prices to keep employment high, allowing inflation to de-anchor and eventually destroy the economy's stability. Fast forward to 2026, the new Federal Reserve Chair, Kevin Warsh, faces the exact same dilemma, but he is choosing a much more aggressive and painful path to avoid the mistakes of the past. Warsh has responded to the oil shock by refusing to cut rates. By holding interest rates high at 3.5 to 3.75%, he is intentionally trying to slow down consumer spending and drain liquidity from the system. The Fed is essentially slamming the brakes on the economy. They are risking a minor crash, a recession, to avoid driving off the cliff of permanent runaway inflation. This means the high interest rates dictating your life, the 6.49% mortgages, and expensive car loans are not an accident. They are the tools the Fed is using to prevent a total stagflationary collapse. The era of zero interest rates is over. We have entered a higher-for-longer environment, where the cost of borrowing capital will remain elevated for the foreseeable future. With rates frozen, high-interest revolving debt acts as a wealth-destroying engine, outpacing your investment gains. Eliminating credit balances secures immediate financial returns. But you can flip the Fed's strategy. High interest rates mean low-risk assets like Treasury bills now generate meaningful compounding returns. Housing requires a new perspective. With mortgages at 6.49% and a structural shortage of homes, renting has become a strategic defensive move. It preserves your liquidity while the market adjusts to these high financing costs. You cannot control energy wars or Federal Reserve policy, but by understanding these forces, you can control your own balance sheet. Financial freedom is built one smart decision at a time.